So a hard money loan is really just a bridge loan. It's really just a bridge loan from a private lender, an unregulated lender. So what are the benefits of hard money loans? Why do investors, first-time flippers all the way to investors with thousands of units? So I've closed over $1 billion in hard money loans, and I can assure you one thing, not every project qualifies for hard money. So in the last video, we talked all about why experienced investors choose to go to hard money lenders like myself versus traditional banks. They choose to pay higher interest rates for short-term executions, the speed, the flexibility, versus going to a bank and getting a 7% interest rate, but maybe not even having the opportunity to do the transaction at all. We talked about all the different aspects about common sense underwriting, isolating your personal credit. And in this video, we're going to get into a little bit more detail on hard money loan programs, a little bit more advanced. We're going to talk about how to properly structure your hard money loan. And there's more to it than just going out and trying to get a 12-month loan. The best lenders may offer you different interest rate options. And in this video, we're going to talk about how to make sure that your loan is properly structured for maximum profitability. So first, let's get into what I mean by loan structure, right? It's that our loan needs to not just fit what our guidelines require, but that it fits the strategy that the borrower is looking to execute, right? So when I think about loan structure, I think about it two ways. And if you're talking to a lender who's just thinking about it one way, then you've got the wrong lender, right? Because I know that my loan programs aren't going to be a fit for every single deal, and you should too, right? So when you're looking at these deals as a lender, you should be looking at it as, what am I doing to help my borrower execute the strategy and keep borrowing costs down, right? That's not to mean lowering interest rate. In fact, I have situations where I increase interest rate and lower points to make it the cheapest overall for the borrower. So we'll get into that, but the bottom line is that when we talk about structuring the loan, we're talking about LTV, loan to value, we're talking about interest rates, we're talking about the term of the loan, we're talking about looking at the borrower's strategy and making sure that what we're offering fits the borrower, and if it's the most efficient loan for them. And again, in the last video, we talked about traditional bank financing versus hard money, and why folks go and pay 12% to a hard money lender versus 7% to a bank. It's more than just that. It's I can get your cost of capital with a hard money lender like myself. I can get it down to almost the same cost as going with a bank if structured appropriately. So we have the programs here at Asset-Based Lending and that can allow borrowers to structure loans that make the capital work appropriately for the strategy, that you're structuring a loan that's geared to a fix and flip because you only plan to have the loan out for 4 to 5 months. You're going to be looking at a loan that's optimized for that exact execution. So it might be that you end up paying a higher interest rate, ironically, for lower origination fees, because the most significant cost in a transaction that only occurs over a 4-month period is going to be the cost of closing. There's a lot to it. When we talk about structuring the loan, though, what we're going to focus on is going to be the value of the property, both as is and after repair. That's the LTV, that loan to value. We're going to focus on interest rates and points being the significant costs at closing outside of title, appraisal, etc. And then we're just going to look at overall repayment terms. We're going to want to make sure that you can execute the strategy within the time frame that we're giving you, right? We're giving you 12-month loans, right? You don't want to be in a situation where you need 3 of your 4 units to vacate, to be able to renovate them, to be able to refinance within the 12-month period, right? You want to have a loan term that matches the strategy as well. So we're going to talk about all that in all of my videos, but in this case, what I want you to focus in on is, when you're understanding loan structure, it's not just to meet my guidelines, it's to meet the strategy and the scope of the project, and to do so in the most efficient manner possible, both from a cost perspective and from a time to close. And hard money loans and hard money lenders in general are a perfect fit for those transitional plays. And we're going to dive deeper into the structural elements of the LTV in the case of a construction loan to cost, LTC, etc. throughout my video series on hard money loans for sure. So when you look at specifically comparing a loan structure to a traditional bank structure, just from an interest rate perspective, we talk about 7% rates versus 12% rates, but it's more important to a flipper or somebody who's trying to execute the BRRRR strategy to get maximum dollars from a lender at close, plus all the renovation dollars, than potentially they would get by going with a bank. So what I like to do is I like to really get specific, and I'm a finance guy, I'm an Excel nerd. I like to look at the numbers, and I'll always lay out cash flows for borrowers. But the fact of the matter is, when you break down interest rate comparisons and you look at how the loan is structured for the investment on the hard money side, then you realize that it makes no sense to talk banks when you're trying to talk about getting an investment finance. You put speed aside and you put the fact that we're looking at the asset, but when you look at the cost of borrowing specifically, and let's assume the banks are charging a couple points, hard money lenders are charging a couple points, and now you're looking specifically at the interest that you're going to pay over time, right? Traditional bank loans, you're going to have, certainly IO periods, but traditionally when you're looking at a lower rate, right, you're looking at amortization schedules and all of that. And it's meant for a 30-year hold. When you talk about hard money loans and you're looking at a 12-month note, you're looking at getting in and out of this project in 3 to 4 months. When you look at a 12% interest rate, the first thing that you could think of is I'm paying 1% per month on the outstanding balance of the loan. And if I have the loan out for 4 months, then I'm going to be paying 4 points in total interest on the loan. And in return, I'm going to get to borrow 80% of the purchase, or as high as 90 in some cases, of the purchase price, plus 100% of construction. And with a bank, you might get a low interest rate, which you don't need because you're only going to hold it for so long. But the fact of the matter is you may not get 100% of that construction financing, or you might get less going in than we can provide. And when you balance those funding and those structural elements and you compare between hard money and a bank, fine, you get a lower interest rate, but you're coming out of pocket more of your personal dollars, which you should ascribe a higher return requirement to than 7%. Maybe your money invested in the stock market's 10%, invested in a real estate project is targeting, 20%. So in hard money, you have less of your dollars invested than you would with a bank. And so when you look at it, you might say on a blended cost of capital basis, I'm actually paying a lower return for the money that I'm investing into this deal, the capital, the sources of the capital for this transaction, going with hard money than going with the bank. So let's talk about structuring a loan properly using the interest rate. I think it's a competitive advantage I have here at Asset-Based Lending, but we offer different rate structures for different situations, right? So we encourage high volume flippers to use our money as efficiently as possible because we want the borrower to scale, we want the borrower to succeed, right? And so when I'm speaking at RIA events or I'm talking to borrowers and I'm just teaching them as to how, when I was flipping properties, how I looked at my overall cost of capital, and that when I look at that and I apply it to this business, I'm looking at my borrowing costs. And as a borrower, I'm saying the hard money lender gives me the ability to transact, they can close quickly, etc. But man, it's a trade-off for that such a high interest rate. And we've talked about why you really can't compare when it comes to speed. But now we can get into the nitty-gritty of what that speed means. Because if you look at my borrower pool and you say, which ones go to which programs, I would say when a fix and flip comes to me, they're coming to me to pay a higher rate and the lowest amount of points possible. Why? Because when you look at your investment timeline, let's say you're looking at a 6-month hold and you're saying, I'm just hypothetically paying 12% in interest. That's a point a month. That's 6 points of interest, right? Or I could pay 9% and 1 point. They're going to be modeling it out and saying, if I have this loan out for 6 months, when you combine the cost of borrowing at closing, which is the origination fee, and then you look at the interest paid on the outstanding balance at the higher interest rate over the 4-month period, you may find that it's cheaper than the interest rate at 9%, paying that 1% upfront in the origination. It's just about time and how fast you can get through these projects. And as you become more of a pro in the space, you will opt to pay a higher interest rate in lieu of paying lower points because you're going to be looking at your cost of borrowing. To now add to that, when you look at those origination fees paid at closing, that's also additional dollars coming out of your pocket. So when you're looking at trying to keep your capital deployed and being used efficiently, you want to keep as little cash in these deals as possible. Well, paying origination fees at close is just as much of a down payment as your down payment actually is, So the fact of the matter is that when my borrowers are coming to me, they're coming to me for fix and flips that are being really flipped in less than, say, 6 months, but definitely less than 8. They're coming to me and they're opting to pay higher rates. They may choose to pay 12% above paying 9.99% in 1.25 points. So when you run the math, and I encourage you all to do that, I want you to look at borrowing costs. I want you to say, okay, I'm paying interest on balance, I'm paying these costs, this origination fee at close with this lender, or I could pay a slightly higher rate and go with a lender like myself who will charge you no fees at close, keep your down payment on your overall investment down, but also give you an overall more efficient, what's called structural execution from a hard money loan perspective, right? Where I'm giving you a loan that's structured for the time period that you're looking to operate within. If you were looking at an 11-month hold because you had tenants in place, I'd say you're better off going 9.99% in 1.25 points. But because you're going to be in and out of it in 4 to 5 months, maybe 6 months on the outside, well then it's better to pay no points at close, go with that higher rate. And that's how I use my programs, both rate and points and 0 points, to kind of structure the deal appropriately for the borrower to maximize their return on investment at the end of the day. So let's walk through a couple of examples that I think best highlight how an investor can maximize their returns using hard money loan programs and structuring them appropriately. And let's talk specifically about return on their investment as it relates to leverage. Hard money lenders can come in and fund 80 to 90% of the purchase price plus 100% of construction. Banks sometimes can only fund a percentage of the purchase price. Sometimes there's apprehension on the borrower's part to have a lender fund construction. So they're thinking in their head they have to bring more equity to the table by not going with a hard money lender, right? Maybe they don't know that a hard money lenders can fund the high of leverage both on purchase and all of the construction. And the reason is because we can fund based on the after repair value. We look at your experience, we want to know that you can execute the strategy, right? And as long as we know that we're lending to a borrower who can execute the strategy, we can give them all of the construction money and reimburse them as the work is complete. And again, we'll talk about construction draws in a different video, but when you're lending opportunistically the way that we are, based on, again, the after repair value, we are come in and fund 80 to 90% of the purchase plus 100% of construction. And that requires the borrower to bring a lot less money to closing. So when you look at the amount of money they're bringing in as being less in one context, you're like, well, that's great. But the fact is that borrower may have had to raise that capital, may have had to bring in a 25 or 50% partner to make up the difference in funding between a hard money loan program and a bank. And they're paying a much higher rate of return as a result in one way versus going with a hard money lender that's a fixed rate of return of, again, 10 to 12%. When you look at the capital stack, when you look at the weighted average cost of capital and you compare hard money loan programs in the instance of just leverage, and you say, okay, much higher rate over here, but I'm paying a fixed cost of capital at 10 to 12% versus having to split profits at 25 to 50%. And so that's how you can get a hard money lender and their loan programs to sort of work for you. You can't be scared off by higher interest rates, because in that case, we just showed how a higher interest rate meant higher leverage, which meant less equity capital raised, and overall, the net profits, the overall rate of return for the borrower, for that investor, is much higher going with a hard money loan program and higher rates versus a bank execution and having to raise capital. So when you look at the different scenarios, right, you come to me and you say, listen, I'm looking to do a fix and flip, or I've got a property that is a 3-family that has tenants in there that have below market rents, right? There's a loss to lease. I want to get the tenant out when the lease expires, and then I want to renovate it and I want to turn it over, increase the rents, and then refinance you out, right? The traditional BRRRR strategy. Those are perfect for a hard money bridge loan, right? They're 12 months. You don't need more than that. You can go renovate the project within the lease, a typical 12-month lease period. You're coming in and you're using hard money for that fix and flip first half of the BRRRR strategy, and to kind of come into it, quick turn. You're looking for fast closing. You're looking for fast money through construction. And ultimately, you're looking for no prepayment penalties, no minimum interest, nothing like that. Hard money loan is the perfect fit. When it comes to, folks that are coming to me, they don't have much renovation work to do. The rents are the rents in terms of what the tenants are paying. They're not really looking at any transitional place. I'm going to immediately move them over to our DSCR program. because there's really no benefit to be going into a bridge other than maybe to close quickly. But we're still going to want to see that transitional play because we don't want to go in at max leverage if there's no upside in the value, right? So when it comes down to deals that are iffy, when it comes to the amount of work that's needed on a multifamily, is there enough upside to justify a bridge loan? If there's not, I'm going right into a DSCR loan where rates are much lower, right? Rates are now in that 7.5-8% range or lower at times, and really float with the 5-year versus the bridge loan rates, which are not really necessarily tied to an index. The bottom line is you see different strategies. You see fix and flip. You see, let's call it a multifamily or any type of investment project that needs that short-term transition. They're going to go bridge. They're going to go hard money. Anything other than that, for me, I'm sending them over to DSCR, where the programs complement each other in terms of, we'll call it financial conditions, requirements of the borrower. But, it's a better option for folks who want to hold because it's a 30-year fixed rate. It's meant for that long-term hold for borrowers who are looking to build a portfolio. You got to be careful. I'd say one of the things that you want to definitely avoid when it comes to structuring loans, obviously, is give yourself enough time, give yourself enough cushion in terms of your own capital. I mean, you want to make sure you have the liquidity you need to get from A to B, whatever it may, however that may be required from your lender. We fund all of the construction always. We'll fund it in draws, but you still need to buy materials before they can be installed and be reimbursed for. So you got to know the different requirements of you, certainly, but we'll get into that. But I think the fact from a structuring standpoint, you want to make sure that you can execute the strategy, that you can, if you're turning tenants over and bumping rents, that you have enough time to be able to do that and to be able to get out of this short-term bridge loan before maturity, right? These loans mature, right? Lenders like us will extend. Not all lenders have the ability or can make the decision to extend their loans even because they sell their paper. Like, you have different lenders for different, borrowers. But at the end of the day, the fact of the matter is we're going to want to make sure that your loan meets your strategy. You don't want to get into a loan that's going to force you to sell the property or to refinance into a bad loan because you didn't take enough time on your loan to get through the strategy. So that's one of the major risks, I would say, to avoid when you're structuring a hard money loan or working with a lender, whether it's with me or with anyone. You want to really make sure that you're transparent about what you're looking to do, and we'll work with you to make sure that the loan fits the strategy. We can never forget about our exit strategies, right? And that's what the lender is going to be focused on. Are you selling it? Are you refinancing it, right? So you want to make sure, just like in the point about over leveraging, you want to make sure that you're going into the deal focused on your exit strategy. You want to underwrite these deals in reverse, right? You want to know what it takes to refinance out into a perm loan before you go in and start looking at an acquisition where you're bringing in a short-term bridge loan. Right? You want to make sure that exit is the first thing on your mind and the last thing on your mind. It's the one thing that you should always be focused on. And we're going to be underwriting to your exit. So if you say, hey, listen, I'm going to sell it, we're going to say, great, could be worth this. And the appraiser is going to qualify, what that property is going to be worth on an after repair value basis. But the fact of the matter is that, values don't always go up. What happens if you need to refinance us out? That's why we have the minimum FICO requirement, and it's usually about 660. But it's also because we want to have that plan B, and you as a borrower, you as an investor want to make sure that if it doesn't go well on a flip and you have to hold it, you have the ability to, that rent covers your debt service payment, and you have the ability to refi into a perm loan without coming to close on that refi with additional cash investment. The next thing is you don't necessarily want to put the lowest amount down possible. And I've seen a lot of situations in the last couple of years in particular where interest rates rose, right? Where borrowers were coming in to put a little bit of money down up front. They were going to buy it, renovate it, and then refinance out of their existing debt with that bridge lender. And come to find out when it was time to refi, they had to bring more cash to closing to pay down the first mortgage, the bridge loan, to a point where they could do a rate and term refi with their DSCR lender. So the fact of the matter is especially in a volatile interest rate environment, it's certainly a risk to go in and put 10% down in some cases if you do in fact plan to refi the deal out, because you might get stuck putting more money into the deal than you thought, but it might come later in the deal. And it's really a shocker when you find out that you have to stroke a check to refi your bridge loan. And I don't want to see that happen to anybody. It's important that no matter which lender you're working with, that they have the ability to access these programs, to give you the versatility to execute your investment strategy. And you need to be able to trust that your loan officer, my equivalent, has the ability to structure these loans within the programs to make sure that you're maximizing the return on your investment. We're here to help facilitate transactions. We want to help you succeed and build your portfolio. And the best way to do that is for you to work with a trusted lender like myself. As always, please don't hesitate to reach out if you have any questions, comments. I'd love to structure your loan. We can do it quickly here. Loans are structured in 15 minutes. We're approving loans in 24 hours or less. So I love the opportunity to win your business. I'd like to thank Asset-Based Lending for sponsoring the video. Please, again, don't hesitate to like, comment, subscribe. It helps the channel grow. And I look forward to the next one.